So, is the stock market about to crash again? What the hell is going on in the markets? If you're looking at the past few weeks and you see that the markets have climbed from about 18,500 points on the Dow back in March to over 23,000, almost 24,000 points on the Dow. What is going on? I'm going to explain exactly what is happening in the markets at the moment. We're going to decide whether or not the markets are going to increase in the next couple of weeks, or decrease in the next couple of weeks, and give you sort of cases for both of those. Look, I'm not a financial advisor. I'm a random person on the internet, but I'm going to give you my 2 cents on this and share with you exactly what I believe is going on in the markets at the moment. So if you're new here to the channel and you want to learn more about personal finance, investing, budgeting, make sure you subscribe to the channel for more videos like this. We do our best to bring out at least 1 to 2 videos per week on these topics. So I saw something just the other day that I think a lot of people could really relate to when they're looking at what's going on, and you see that the markets have climbed quite a bit from about 18,500 points to over 23,000 points in just the last few weeks. This is the Dow Jones Industrial Average, which essentially tracks the overall stock market in America. It's a pretty good indicator of how American stocks are doing at the moment. And so seeing this climb, a lot of people have been scratching their heads saying, why is the stock market climbing? Maybe they've heard about some stimulus deals, maybe they've heard about some other things, but they're still looking at unemployment numbers. They're looking at the amount of people who are out of work, and they're looking at the deaths that are occurring, and they're thinking, this cannot be good in any case whatsoever. Why the hell is the stock market increasing? And so there's a couple of reasons for that. We will dig into that, but what I really want to do here is kind of lay out the case for why the stock market might decrease in the next couple of weeks, and then why the stock market might actually go up in the next couple of weeks as well. So what we first have to do is we have to do just a little bit of homework here. We have to look at the stock market on February 12th when it peaked at 29,551 points. This is a pretty big number. It almost crossed over 30,000 points on the Dow, and historically, if we track this back, say 20 years, yes, that's a pretty big increase. And the stock market over pretty much all of the 2010s has been doing extremely, extremely well. It's been in a massive bull run. Obviously, that bull run is over as of last month, but from that point, we saw within less than 6 weeks, we saw that the stock market slid down to 18,591 points as we saw this big fear going across the globe for pandemic, right? Now, over this time, a lot of people sold off a lot of their stocks, but at this point here at 18,591 on the Dow, is this the very bottom, or are we going to go further down? That's the big question that a lot of people are asking. They're saying, should I invest now? Should I wait? Should I wait till it slides further? All right, so let me give you some reasons for why the stock market might go lower than what it is now. One of those most obvious is just looking at the data points for companies' earnings reports that are probably going to be coming out, most of them of which are going to be coming out in April, and then we're going to see Q2 earnings reports from a lot of companies in July most likely. But what a lot of people are looking at is the unemployment rate, and they're looking at the amount of people who have applied for unemployment in just the past 4 weeks. This statistic is absolutely alarming. In just the past 4 weeks, we've seen over 17 million people apply for unemployment. In fact, that's so much that we literally have to scroll up on this graph just to see how many people have filed for unemployment recently. Now, looking back on some of these other numbers here, these are the past recessions. This is the past unemployment rate in past recessions. Now, obviously, a lot of this is caused because, well, everybody's on lockdown, right? Nobody's leaving their house, and so a lot of people don't have jobs. And the thought here from a lot of people is that this is going to blow over, and we're going to go back to work, and everybody's going to go back to their job, and the unemployment rate will come down so quickly. It'll go from maybe 20% or 30%, come crashing down to where it was previously at 4% or 5%. Now, for people who are bears, people who don't believe that the market should be this high at the moment, one of the things that they really think is that the unemployment rate, it's going up quite significantly at the moment, but people are fearful that it's going to stay at a high level for a long period of time. Let me give you a quick reason why a lot of people are believing that. So let's say that you are a waitress, you're a waiter somewhere, and maybe your restaurant opens back up in June, maybe July, sometime in the summer. Now, if it opens back up, a lot of people believe that there might not be as much business at the restaurant for potentially through the rest of 2020, because what have people been doing this whole past spring? Well, a lot of people have been having no income, no money flowing in, but they're still throwing stuff on their credit cards. They still owe their landlord 3 months rent. They still have to pay for their mortgage. They still have to pay for their car payments. So people are behind on their payments. So they're probably less likely, or at least in the numbers that we saw previously, less likely to go out and start spending money at restaurants, start spending money at amusement parks, start spending money all over the place, right? So they're less likely to do that. And so the unemployment numbers might linger at a higher level than just this quick little V that a lot of people were hoping for a recession like what we're in at the moment. Now, I'm trying to not give my opinion on this too much because I think there's very many valid points to both sides of the story, but I think every day as we go further on here, it's less likely that we're going to see a quick V recovery where we enter into a recession and then bounce back absolutely immediately. Now, another reason why we might see the markets slide even further is because this is very much uncharted territories. We don't know how to deal with a situation like this at this level. We don't understand this illness. We don't understand a lot of things that are going on at the moment with health, with humans, with the markets, and with the economy. And so because of that, whenever there is more unknown, whenever there is more risk involved where we don't truly know the potential outcomes, there's going to be a higher level of risk and a higher level of volatility. There's the one thing I can promise you this. There will be large amounts of volatility throughout 2020. That's nearly impossible to not see those levels of volatility. Gone are the days of the stock market going up 0.25% and then the next day it goes down 0.5%. Those were the nice days. Today, you're going to be seeing probably for the rest of 2020, the markets are going to pop up 5%. They're going to come crashing down 10% the next day. And so that's just something that you do very much want to be aware of. There's going to be a lot more volatility, a lot more movement, a lot more volume in general as people get cold feet or as they start to hear good news or bad news. They're going to be making a lot of investment decisions based off of that. And the final reason for why people might believe that the markets are going to go down is because they believe that at some point reality is going to set in for investors where they realize that, look, a lot of companies, they're not going to be bouncing back as quickly. And although this illness may be gone in a year, in 2 years, in 3 years, a lot of the economic effects from that might not be gone and they might linger for some period of time. So even if you're throwing money at this, even if the government's printing money, there's only so much that you can do. All right, so now let's take a look at some reasons as to why the markets might continue to climb in the coming months and through 2020. Now, one of those reasons, one of the overlying reasons, is because people realize that at some point there is likely to be a cure. This illness will be gone at some point in the future. Maybe it's not for many months, maybe it's not for many years, but at some point people will overcome this and we will go back to business, we will go back to our jobs, and that's not to in any way downplay any of the health or the deaths that are occurring. That hopefully you see where we're coming from on that point. But people realize that at some point there will likely be a vaccine, right? And so when they realize that, they believe that, well, if you're a long-term investor, then if you're investing for 3 years or 5 years or 10 years from now, then you should really look at the long-term ability for that company to make a profit and increase their revenues over that long period of time, rather than this one occurrence in 2020 over a span of a few months and looking at the big picture. That's one of the reasons why people are kind of holding steady with a lot of their investments. But by far, the largest reason for why the stocks have increased from 18,000 points on the Dow to over 23,000 points is because of stimulus deals that have been passed in the United States and probably throughout the world in a lot of other countries as well. Now, there's a couple of things to note with this. First of all, stimulus deals that have been passed, there's a lot of videos out there on those topics, but a lot of Americans getting $1,200. Okay, it's probably going to help some people pay their bills. When we got news of that, we saw the markets started to climb. And this was really when we saw this trench, March 23rd, was really before we saw any news on actually passing these stimulus deals. And so the stimulus deals, there's a lot of money flowing into the markets, a lot of money flowing into businesses who maybe they're struggling to pay their employees. And so the government's giving trillions of dollars worth of loans to people and to businesses to hopefully try to alleviate some of this pressure that businesses and people are feeling at the moment. So the Fed has pledged infinite money to fight this issue. And I think when people saw that, they got pretty excited in terms of investing because they realized that the government will do anything to keep the markets propped up. But there will likely be a lot of companies who are bailed out from their current situations. Companies who were potentially far over leveraged, or say they took 94% of their free cash flow and put it all back into stock buybacks, airlines. But a lot of these companies are going to be bailed out. And it kind of creates this problem. It's really this catch-22, where if you look at it and you say, well, some of these companies were operating where they were doing very foolish things with their money. They were totally over-leveraged, and they should have to pay for that. They should have to realize that they can't just get away with over-leveraging and overextending every single time we enter into a recession. This is kind of a repetitive thing that we've seen in the past. We saw this quite a bit in the last recession in 2008. But the problem here is that if you don't bail out some of these companies, a lot of people are going to end up out of work. Let's take Boeing, for example. Let's say that Boeing is crashing to the ground and they're about to go totally under and they're going to go belly up, right? Now, if that were to happen, they employ over 160,000 people. And most of those people who work at Boeing, they're blue-collar workers, union workers who just want to put food on the table, pay for their mortgage, help raise their family, right? Most of those workers are just average Americans who are attempting to just live a normal life, pay their bills, and just try to make ends meet, right? Now, if you let a company like Boeing totally fail and fall on its face and go under, the problem is that a lot of people, a lot of average Americans are going to be paying for those mistakes that CEOs or bigwigs on Wall Street made. And so that's really the problem here. So how do you punish the people who made poor decisions financially, who over-leveraged or who made foolish decisions and didn't prepare for a rainy day? How do you punish those people without punishing the broad overall public, middle-class people? And that's kind of the problem that a lot of people face. Because if you let them fail, let's take a look at Lehman Brothers. The first deal for a government bailout for Lehman Brothers didn't go through, right? And Lehman Brothers fails. A lot of people were out of work, but more importantly, the economy almost collapsed during that time when we had all of those problems. So yes, a lot of companies will likely be bailed out by the government. Now, the one difference here between this event and 2008 during the financial crisis, there is a difference. And the difference is that during this time, businesses did not cause this recession. They did not single-handedly cause this recession. It was this black swan event, something that was difficult to predict that we were going to have this massive issue in 2020, right? Back during the financial crisis that we had about 12 years ago, that was caused by the businesses making borderline, well, actually, in yes, many cases, fraudulent decisions that were very poor decisions, okay? So there is a difference there. I do want to definitely make that very clear. But yes, a lot of companies probably will be bailed out, large corporations, and then they will continue to go on and just be incredibly over-leveraged and start to spend more money. And then next recession, they'll probably get bailed out again by the governments. But that's one of the reasons why we're seeing the markets climb, because people say, hey, the government's going to bail them out, right? Where are they getting the money from? Good question. Well, we have a lot of different ways that we can get the money, and we might have to make a separate video for that. Now, there's really two other things that I wanted to include in this video. One of them, one of the reasons why I believe that the markets are continuing to climb, why we've seen them go from 18,000 to almost 24,000, is this FOMO, right? It's this fear of missing out. People are trying to time the market. So many people, millions of people, are trying to time the market for the absolute bottom. And what happens when they don't get that bottom? Well, they start to just pump money in because they're scared that they're going to miss out, because they see that the stock market is still down from its all-time highs in February. So they start to buy in. Now, I want to warn people that I believe, and this is a prediction, I don't like to make too many predictions on this channel, but this is a prediction that I believe there are going to be a lot of bears, a lot of people who are sitting on the sidelines, maybe they have money invested, and they're waiting. They're waiting for the markets to climb to the perfect point where they're going to start unloading their shares because they are bearish on the markets. And I think we're going to see that, once again, just a lot of volatility in the markets. And if you can't handle this volatility, if you can't handle gaining 10% or losing 15% in a day for your investments, then you might want to think about rearranging your portfolio into something more stable if that's something that you really can't handle. I know a lot of people who get extremely stressed about volatility in their markets, where they're looking at their stock portfolio and they lost $30,000 in a day, and it's quite stressful for them. And then the next day they gain 40,000, but it's still incredibly stressful. So I wanted to leave you with this. Look, I invest for the long term. Am I investing right now at the moment? Yes, but extremely selectively, not as much as I was pouring in the past couple of weeks when the markets were down below 20,000 points. but very selective. And I want to remind you that during any time, during any economic climate, whether we're in 2006, right before the big crash, or whether we're in the fall of 2019 or in the winter of 2020 back in February, if you were buying stocks on February 12th, there were some deals in the markets. There were some stocks that you could have bought on February 12th that you could be up right now at the moment. So there are always going to be stocks that you can invest into at any market climate. I just wanted to remind people of that. It can be more difficult to find them, and it's even more difficult at this moment because the problem is that we don't really have accurate earnings reports. We don't even have earnings estimates that we can go off of because we have absolutely no idea how much money some of these companies are pulling in. I mean, how does the revenue look? Is it going to be down 25%, down 50%? We really don't know, and we're not really going to know that until a lot of companies post their earnings reports in April, so this month, and then also for Q2 in July. So very much keep close eyes on those companies' earnings reports. That's going to make a big difference. So thanks for watching the video. If you found any value, make sure you drop a like, subscribe to the channel, and I'll see everybody in next week's video.